Welcome back to MSME Talk podcast for micro, small, medium enterprise businesses and startups.
This is episode number 60 of MSME Talk on MSME sector insights, facts, policy trends, and budget for 2026-27. For better experience, I would suggest you to switch to 1.25x speed and also don't miss to subscribe at the rate MSME Talk on YouTube, Apple, and Spotify.
Hello MSME Talk listeners, I am Swapnil, your host, economist and researcher at MSME Talk. Today we are going to analyze the budget 2026. But before that, we will cover key trends, facts and insights on the MSME sector. Then we will proceed with budget related announcements and analysis. This year, we are doing something special for all of you. And that is that if you need a digital copy of this budget report, you must send a message budget report on WhatsApp number 8097665085. The details are on your screen. And before proceeding ahead, I would like to shout out to MSME Talk Insights and Update Desk team member Shilpa for putting all this data and analysis together. Now, let's get started. Let me begin with the most striking development in the MSME ecosystem this year. In just 1 year, India added 1.6 crore MSME formal registrations. Total registrations rose from 5.95 crores in February 2025 to 7.6 crores in February 2026, a growth of nearly 28% year on year. This trend has been seen since the launch of the UAP initiative by SIDBI in January 2023. The data also shows that almost 45% of all MSMEs in India come from only 5 states, namely Maharashtra, Uttar Pradesh, Tamil Nadu, West Bengal and Karnataka. That tells us that MSME growth is not evenly distributed across India. Interestingly, this year Karnataka has entered the top 5 MSME states, replacing Madhya Pradesh. Now, let's talk about the structure of MSMEs, because this is where the real policy challenge lies. Micro enterprises dominate 99% of all the MSMEs in India, while small and medium enterprises make up just 1%. That means India is creating new enterprises, but they are much smaller in size. One point that may be missed while looking at this data is that last year the classification was changed and many small companies could have shifted to micro segment, resulting in more micro companies. Similarly, many medium enterprises might have moved to small category too, because we can see that small enterprises declined by nearly 34% year on year and medium enterprises fell by almost 47%. Only Mizoram recorded a net positive addition in small enterprises this year. No single state or union territory added medium enterprises on year basis this particular year. While in our last year's report, we saw Maharashtra and Gujarat showing growth in number across micro, small and medium enterprises. Let us now look at how states are performing. Maharashtra remains the largest contributor in absolute terms, adding 21 lakh MSMEs this year, with 27% growth. Uttar Pradesh grew even faster in percentage terms at nearly 31%, adding 19.6 lakh enterprises, while Tamil Nadu added 12.1 lakh enterprises. But some of the most interesting signals come from smaller states. Meghalaya recorded highest year-on-year growth at nearly 69%, followed by Arunachal Pradesh at over 42%. So while large states dominate in volume, smaller states are closing the formalization gap. Now let's take a step back and see how MSMEs fit into the broader economy. The share of MSME gross value added (GVA) in India's GVA has shown a fluctuating trend over the years. Prior to COVID, it was around 30%. In FY21, the share dropped significantly to 27% due to COVID. But it slowly recovered to 30% in FY22 and FY23, reflecting economic recovery, policy interventions, and increasing formalization. By FY26, it is projected to touch 31%. Exports tell an even stronger story. The MSME share in merchandise exports rose from 45.7% in FY24 to 48.6% in FY25. Public procurement has quietly become one of the strongest pillars in support of MSMEs. Total procurement from MSMEs have crossed 2.6 lakh crore rupees in FY25. In FY26, as on 5th February, it has reached over 1.65 lakh crores. Therefore, for FY26, the total procurement might not exceed last year's record unless the orders spring up as the financial year ends. Usually, the last couple of months are crucial as we see a rise in orders in those 2 months. Of the total procurement, around 80,000 crore rupees is from micro and small enterprises. This value has nearly doubled in last 5 years. Its share in the government procurement has risen from 27% to over 48%. This reflects better enforcement of the 25% procurement mandate, wider MSME onboarding on GEM or Government e-Marketplace, and improved compliance monitoring. Even more encouraging is that procurement from women-owned businesses has grown over 8 times, while SC/ST MSE procurement grew more than 4 times. One issue that keeps bothering is that despite 40% ownership of women in MSMEs, share in total procurement from women micro and small enterprises has been around 3%. At the same time, while procurement value is rising, the number of unique MSE sellers, irrespective of gender or caste, has plateaued in FY26, suggesting concentration among existing vendors. Now let us quickly have a look at key schemes under MSME Ministry and their allocations, starting with PMEGP, Prime Minister's Employment Generation Program. PMEGP, since its inception, has supported over 10.7 lakh micro enterprises, generating 87 lakh jobs, and disbursed nearly 29,000 crore rupees in margin money subsidies. In just the current year, till December 2025, it supported 84,000 enterprises, creating an estimated 6.7 lakh jobs. In FY25, the allocation has been around 2,200 crore rupees, slightly down from over 3,000 crore rupees in FY24. However, in FY26 revised estimates, we see an uptick at 2,500 crore rupees. But in FY27, the allocation has jumped to 4,500 crore rupees, doubled compared to FY25. Then the RAMP scheme. It focuses on deeper structural reforms like center-state coordination, market access, greening of MSMEs, and delayed payment resolution. So far, 3,200 crore rupees worth of proposals have been approved, impacting over 10 lakh MSMEs. In FY25, RAM's allocation was halved from around 1,300 crore rupees in FY24 to more than 600 crore rupees in FY25. In FY26 revised estimates, it's now over the FY24 allocation, more than 1,400 crore rupees. In FY27 budgeted estimates, its allocation is around 1,500 crore rupees, almost similar to FY26 but more than doubled compared to FY25. Now, a quick word on credit support schemes. The Guaranteed Emergency Credit Line or GECL is a government-backed loan that offers extra working capital to MSMEs, businesses, and other eligible borrowers affected by economic disruptions during COVID-19. It shows an interesting budget trend. Despite repeated budget allocations in FY25 and FY26, actual spending was zero. Yet 9,000 crore rupees has been allocated once again in FY27. This means that it didn't get any fresh allocation in the last 2 years. The last we saw was in FY24 with 9,000 crore rupees allocation. However, last year the loan limit was extended to 10 crore rupees from 5 crore rupees. This suggests the scheme is being kept alive as a contingency tool for MSEs rather than an active credit channel. Moving on to technology and skills upgrading, technology centers have grown across the country with an initial allocation of 6,000 crore rupees between FY19 and FY22. Later, its outlay was decreased to 3,500 crore rupees. In FY27, the allocation is around 531 crore rupees. However, the government has been focusing on PM Vishwakarma scheme that targets artisans and craftspeople. It has already registered 30 lakh beneficiaries, trained 7.7 lakh individuals, and disbursed over 2,200 crore rupees in credit support. It has helped traditional businesses to integrate with global value chains. Then, there are a host of other schemes which need to be highlighted that have helped boost entrepreneurial skills, cluster-based development for traditional industries, productivity, competitiveness, innovation, and rural entrepreneurship. They include ESDP, MSc CDP schemes, Furti scheme, Aspire scheme, and MSME champions. You can get the details of these schemes in the report. Send a WhatsApp message to get the report. So, to sum up, government is focusing on skill development at base of the pyramid and is also addressing credit issue that has been a pain point for many MSMEs across the pyramid. Through these policies, we are seeing some progress in market integration and efforts. They are also benefiting from stronger procurement and policy coordination among different ministries. Various structural issues still challenge the business community. From a macro perspective, one of the core issues is that the sector is dominated by micro enterprises. This keeps our scale smaller. With that context in mind, let us now turn to Budget 2026 and examine how this year's budget helps MSMEs. For clarity, I am dividing the MSME related announcements into four broad categories. First, budget allocation analysis. Second, direct budget announcements through MSME Ministry for MSMEs. C, sector specific opportunities. And D, indirect and enabling announcement. Let me start with overall allocations to the Ministry of MSME. In FY24, the overall allocation was around 21,000 crore rupees. In FY25, the budgeted estimates were 22,000 crore rupees. In revised estimates, it was dropped to 17,000 crore rupees, while in reality, the amount actually spent was just over 8,000 crore rupees. In FY26, the budgeted estimates again reached 23,000 crore rupees and down to 12,000 crore rupees in revised estimates. In FY27, the budgeted estimates are set to 24,000 crore rupees once again. That's more than double of FY26 revised estimates. Over the last 2 years, actual spending has consistently fallen far short of budgeted numbers. So that is a bit worrying signal. But here is an important consideration. The headline MSME budget numbers may look stable over the years if we remove emergency credit allocations, GECL or Guaranteed Emergency Credit Line from total expenditure. Non-GECL figures go something like this. In FY23, 13,000 crore. In FY24, 7,700 crores. In FY25, 8,200 crores. FY26 RE, 12,000 crore. And FY27 budgeted estimates, 15,500 crore rupees. The core MSME development spending or non-GECL expenditure has grown nearly 50% in the last 2 years. Now, this can be further split and that spending mix tells us more than the headline total. Over the past decade, MSME spending has shifted sharply across phases. The share in the earlier years was something like this. PMEGP got the bigger share, followed by technology upgradation, khadi and credit support. But overall, all had meaningful shares. Between FY21 and FY24, credit guarantees and funds dominated, accounting for nearly 70% of total spending. In FY25 and FY26, PM Vishwakarma emerged as the single largest item, taking roughly one third of allocations. Now, in FY27, the focus seems to be on credit guarantees, accounting for nearly 44% of total MSME allocations. However, if we consider non GECL allocation, then the distribution seems more even. The focus is again on skill development and development of entrepreneurship at the bottom of the pyramid. One thing to note is that the classification of MSMEs has not changed this year as it was changed last year itself. Now, let's come to the most important announcements of this year, the ones that directly affect MSMEs. These are targeted, high impact measures designed specifically for the MSME sector, and they stand out from the broader policy announcements. For clarity, we can group this year's key MSME focused measures into three broad categories. First, equity support announcements. Second, liquidity support announcements through TReDS overall. And third, professional help and industrial revival announcements. Let's start with equity support. Two announcements stand out here. First, a 10,000 crore rupees SME fund aimed at creating champion SMEs. It will plug the equity gaps in businesses and complement bank credit. This will give high potential MSMEs access to capital without a collateral burden. This scheme is for small and medium enterprises. Second, a 2000 crore rupees top up to the Self-Reliant India Fund, which focuses on risk capital for micro enterprises. These announcements can help MSMEs scale their business. Now, coming to liquidity support, the budget makes a decisive push for the fixed delayed payments issue, one of the oldest MSME pain points. Key steps include making TReDS mandatory for CPSEs. Due to this, the delayed payment risk will be lowered at the sovereign buyer end, and that will help create demand for the platform. Second, backing invoice discounting on TReDS with CGT-MSE guarantees. This will lower risk for financiers, and that can result in cheaper cost of funds for MSMEs. Third, linking government e-marketplace or GEM with TReDS for real-time transaction visibility. This will bring a broader ecosystem into TReDS exchange, giving lenders more information and MSMEs more financing options. Fourth, introducing TReDS receivables as tradable asset-backed securities. By doing this, a secondary market for discounted invoices can develop, which could be a game changer for MSME financing. It may take some time, but over the long run, it can bring more institutional funding into MSME portfolios backed by better data and performance history. All these steps will further boost the TReDS platform and will help MSMEs compress working capital cycles and are in direction to solve the delayed payments problems faced by MSMEs on a regular basis. TReDS stand for Trade Receivables Discounting System. It is a centralized digital framework that enables MSMEs to receive faster payments by discounting their approved invoices raised on corporate and government buyers. Within this framework, there are multiple TReDS platforms where MSMEs and financiers come together. Once a buyer accepts an invoice, banks and NBFCs compete to finance it, allowing MSMEs to get paid early without providing collateral, with credit risk largely linked to the buyer. Now, if you want to go deeper into how TReDS actually works beyond the budget announcements, we have already covered this platform extensively on MSME Talk. In episode 15, we explained why TReDS was created, how it benefits MSME sellers, corporate buyers, and financiers, and why it is becoming a must-use platform for managing working capital. In episode 50, we looked at real usage data, which sectors are actively discounting invoices, where rejections happen, which cities and states are emerging, and how ticket sizes and repeat usage are evolving. In episode 56, we spoke to CFOs from medium, large, and PSU enterprises to understand how TReDS is actually improving their cash flows, vendor relationships, and treasury efficiency in practice. And in episode 57, we discussed how enterprises should think about adopting TReDS and where the platform is headed. So, while the budget strengthens TReDS from a policy angle, These conversations show why the platform is already becoming critical on the ground. Now, back to the budget announcements. Two quieter but important announcements sit in the next category. The Corporate Mitra framework aims to create accredited para-professionals who help MSMEs with compliance at affordable cost, especially in Tier 2 and Tier 3 towns. Alongside this, 200 legacy industrial clusters will be revived through infrastructure and technology upgrades. This addresses the capability and handholding gap, not just the credit gap, a crucial but often ignored constraint. Now, let's see some sector specific announcements where MSMEs can get impacted directly. First, textiles. Among all sectors, textiles clearly receive the most layered and detailed policy attention in this budget. Let me break this down, starting with Samarth 2.0. It modernizes textile skilling ecosystem through collaboration with industry and academia. Then we have an announcement on mega textile parks by challenge mode. 5 new mega parks with a focus on value addition to technical textiles will be created. However, announcements about textile parks have been made in earlier budgets too, and we haven't seen them fructify as of today. Then there's Mahatma Gandhi's Gram Swaraj initiative. It is aimed at strengthening khadi, handloom, and handicraft through global market linkage, branding, training, and skilling. Then the government has extended the export obligation period for leather and textile exports from 6 months to 1 year. It has also allowed duty free import of certain inputs used for leather exports. Then the government has announced National Fiber Scheme that covers natural fibers, man-made fibers, and new age fibers for self-reliance. It will be a part of the broader integrated textile program. Then there is also textile expansion and employment scheme. Here the government supports getting machinery and upgrading technology. The government's National Handloom and Handicraft program aims to integrate and strengthen existing schemes and provide targeted support for weavers and artisans. And finally, there is also Tex Eco initiative, which will be promoting globally competitive and sustainable textiles and apparel. Textile remains India's most MSME heavy manufacturing sector. Millions of micro and small units exist across spinning, weaving, processing, garments, handloom, handicraft, and a whole range of supporting activities. We have actually covered textiles quite extensively on MSME Talk before. In episode 39, we looked at India's textile industry as a whole. The process, the size of the market, export trends, fragmented supply chains, logistics challenges, and rising competition. Then in episode 41, we went deeper into man-made fibers. We discussed the global picture, where India stands today, and walked through the polyester and viscose value chains to understand where value is created and where India needs to catch up. And finally, in episode 43, we did a deep dive on textile specific schemes from PM Mitra and cluster development programs to Samarth and National Technical Textile Mission. So if you are interested in understanding how the textile sector works, I would strongly recommend listening to those episodes. Now coming back to the budget. Textiles are one of the few sectors where policy approach actually looks end to end rather than scattered across different announcements. And there is a reason for that. The industry is under pressure on multiple fronts. Those issues have already been discussed in the said episodes. Trade relations with the US have become more important. Even where trade deals exist, competition from Vietnam and Bangladesh has intensified. At the same time, India is signing trade agreements with several countries, and domestic textile ecosystem needs to be ready for a much more competitive global environment. Whether all these initiatives lead to more jobs, better skills, higher capacity, more value addition, and stronger exports will depend on how well they are implemented. But in terms of intent and overall design, textiles clearly stand out as the most MSME relevant sectoral push in Budget 2026. Now let's move to the next sector, capital goods and manufacturing enablers. This includes high-tech tool rooms offering precision manufacturing access, a 10,000 crore rupees container manufacturing scheme, expanded support for construction and infrastructure equipment. Then there are a few announcements in strategic and sunrise sectors, such as adding 3 chemical parks, creating a dedicated rare earth corridors in Odisha, Kerala, Andhra Pradesh, and Tamil Nadu. Outlay of electronics component scheme has been increased from slightly less than 23,000 crore rupees to 40,000 crore rupees. Announcement of the Biopharma Shakti program, where 10,000 crore rupees will be allocated over 5 years for creating an ecosystem for biologics and biosimilars. A dedicated initiative for manufacturing, R&D and innovation in sports equipment design and material sciences will also be in place. And finally, in this year's budget, we have seen an increase in auto PLI scheme allocations. These sectors have direct and indirect engagement with MSMEs, and we hope that when these announcements roll out on the ground, MSMEs will definitely benefit from them. Then there's a proposal to open She Marts or Self Help Entrepreneur Marts. These would be community owned retail outlets which will help women entrepreneurs scale their businesses. The budget also gives way to revive tourism through new institutions, skilling, eco trails, and much more. It has also given a boost to the creator economy through content creator labs in schools and colleges. Most of the sectors discussed here are dominated by MSMEs. All these initiatives will either help MSMEs directly to scale, upskill, or improve capacities, or indirectly by providing goods and services to larger players. Finally, we will discuss some announcements that are not directed at MSMEs per se, but they are impactful enough to ease the pressure on the businesses in general, or they can boost the top line or bottom line indirectly. This is the enabling layer for businesses. They are often underestimated but powerful. Let's start with announcements related to trade, logistics, and export easing. Key changes include removal of courier export value cap. The 10 lakh rupee per consignment value cap on courier exports is completely removed. Concessional one-time SEZ to DTA sales have been allowed to ease some pressure. Then there are announcements on expanded freight corridors, waterways, and coastal shipping. These measures quietly lower transaction costs, which matter enormously for smaller exporters. Next, taxes and compliance simplification. We now have extended deadlines for revised returns, new filing timelines, and penalty rationalization. Customs warehousing rules have now shifted to an operator centric self declaration model with a single interconnected digital window for all cargo clearance approvals. These measures reduce compliance anxiety, not just compliance cost. Under various policies catering to skilling, knowledge, and infrastructure, the government is pushing more AI driven skilling, university townships near industrial corridors, clean energy initiatives, and digital customs systems. These are long term ones, but very important for MSME productivity in coming years. In the short run, benefits might be seen only in certain places and sectors that provide raw materials, services, or support to these industries. Before we close, it is important to highlight a few major policy moves announced outside of the budget, which still have a meaningful impact on MSMEs. First, the Export Promotion Mission or EPM. This is led by Ministry of Commerce and Industry in coordination with Ministry of MSME and Ministry of Finance, and it is implemented by Directorate General of Foreign Trade. With an outlay of 25,000 crore rupees from FY26 to FY31, EPM brings export finance, compliance support, and market access under one integrated, digitally driven framework. Alongside, there is the Credit Guarantee Scheme for exporters too, which was approved in November 2025 by the Finance Ministry. With a 20,000 crore rupees government guarantee valid up to 31st March 2026, it enables 100% collateral-free export credit for MSMEs. Together, these two measures address both capability and liquidity constraints faced by MSME exporters. On domestic credit side, a key regulatory change has come from the RBI. From 1st April 2026, banks are mandated to provide collateral-free loans up to 20 lakh rupees for micro and small enterprises, doubling the earlier 10 lakh rupees limit. This applies to all eligible MSEs, including PMEGP beneficiaries. Supporting this is the CGT MSE, the backbone of India's collateral-free MSME credit system. By guaranteeing 75 to 85% of loans and with coverage now extending up to 10 crore rupees, CGTMSE enabled nearly 3 lakh crore worth of guarantees in FY25 alone. All these measures show that the focus is on building a strong system that helps businesses grow and export more. So, to conclude, India's MSME sector is expanding in numbers, formalization is accelerating, and policy attention has deepened. We are seeing progress in credit access, public procurement, exports, and interministerial coordination. At the same time, the data also highlights some persistent structural challenges. The sector remains overwhelmingly dominated by micro enterprises. Graduation into small and medium firms is weak, capacity creation is uneven, and execution gaps continue to limit the impact of many well designed schemes. Budget 2026 tries to ease some pressure. On one hand, the government has been proactive. It is trying to make the policies more robust, especially in areas like bank credit, credit guarantees, export promotion, and delayed payment reforms. The sector specific intervention, especially in the case of textiles, have been remarkable. It has shown readiness to announce measures along with RBI to tackle a few issues outside the budget. However, spending credibility and implementation quality remain key risks. We hope you liked this episode. Let us know what else you want us to cover in the next episodes. I would like to thank our analyst Shilpa once again for all the research and efforts. As mentioned earlier, now you can get this presentation on your devices easily. Just mention budget report and send it on WhatsApp to 8097665085. That's it for this episode. Send us your feedback on connect@msmetalk.com. And if you like this episode, please don't forget to spread the word on social media. Also, subscribe to our newsletters. They have loads of information on what's happening in the MSME world. Thank you for listening.
Dear listeners, since last 3 years you have been listening to MSME Talk audio podcast on Apple, Spotify, Amazon, etc. Now it is available in video format on YouTube as well. Also, I would like to tell that more information and updates are not covered on podcast, for which you have to ensure that you subscribe our newsletter and follow us on social media. Links are given in description.